Assalamu alaikum everyone. So here we are covering remaining of the topics of the chapter. The first topic is the goals of the corporation. Corporation have some certain goals like stockholder wealth maximization, social responsibility, stock price maximization, and social welfare. So increasing the stockholder wealth maximization is the basic goal of organization, and this goal is achieved with the increase of stock price. So stock price is attained high stock price or stock price maximization is attained with the help of EPS, determining EPS or evaluating EPS with respect to risk and time, because risk and time are associated with the earning per share. They limited the risk, and in the shorter period of time, if returns are high, then it means that earning per share is high, which increase stock price maximization, which is the basic goal of organization because it increases the wealth for the shareholders, and it is the which means that the stock wealth maximization has attained. Now, to achieve maximization or shareholder wealth maximization, some managerial incentives are provided. As we know that shareholders are owner of the firm, they own high percentage of shares inside the firm, so they have the authority to elect a board of director. Now these board of directors they select management team. Now management team they operate in the best interest of the shareholders. Managers of the large organization they work hard, and as they exert their full potential, so they hold some percentage of or a reasonable level of return and devote some of the returns to the employees and public service activities. But it is impossible to determine that whether managers are working according to the interest of the shareholders, because sometimes they are trying to satisfy shareholders, and on the flip side they follow other goals like investment in the employee and community benefit programs. They think that these are the programs they increase the shareholder wealth. They are the basic factor for the shareholder wealth maximization. But here comes a cost, a level of a cost. These are the factors they can increase cost for the firm. So we cannot say that yes, basically managers are working according to the interest of the shareholder. It is impossible to determine to say that the or to evaluate and determine that whether managers are working according to the shareholders wealth maximization, because on another perspectives they are following their own interest, and for their own interest they work hard. They try to increase firm value so that the returns are increased for their own benefits. Managers operate in a competitive environment. They undertake actions, but and they try to exert their potential, which is consistent with the shareholder wealth maximization, which is the one of the basic objective of the organization. And managers are directed by the board of directors to work according to the shareholder wealth maximization. Now, another component is social responsibility. Social responsibility means that business is concerned with the welfare of the society. So firms they are performing according to the ethical manners. They have ethical responsibility, as we know that they provide safe working environment to the employees, not only to the employees but to the public as a whole. They avoid air pollution and water pollution. So those firms who are socially responsible firms, they have high cost. When cost increases, their product or their pricing, their product and stock prices increases. So their prices increases, then it's become really difficult for the firms when the commodity prices of the firm who are socially responsible increases. Then it is bit difficult for the firm to attract a certain amount of a capital. Then if the firms who are operating in a particular industry and whose normal return and the rate of return is closer to the average return, then they are able to attract capital. So the firms who are socially responsible firms, their costs are high, their prices are high, and it is very difficult for them to compete with other firms in that particular industry where who are not performing social responsibility or who are not socially responsible, they are not investing in the community programs. So, but their profit or their net income is equal to the normal profit, or the rate of return are equal to the or closer to the average. So these are the firms whose cost is minimum and prices are minimum. I will tell you again. It means that those firms who are not following social responsibility, their cost is minimum, their prices are minimum, and their average, their return, their normal return or rate of return is closer to the average. These are the firms who are performing good in the industry as compared to the firms who are performing social responsibility and they have higher cost and high price commodity. Then it is very difficult for them to compete with other firms in that particular industry. Now the next component is stock price maximization and social welfare. So here, as I already told you about the social welfare, which means that the organization, they work best for the for the community's welfare. And now we have the another topic that is called agency relationship. In agency relationship, what does agency relationship means? It means a relationship between managers and shareholders, between managers and debt holders. So managers, they have their own personal goals, and these managers, they compete with the shareholder wealth maximization. As managers have their own personal goals, shareholders have their own personal the shareholders want to increase their shareholder wealth. So shareholder wealth maximization is the basic concern for the shareholders. When personal goals are become a basic concern for the managers, that arises a conflict of interest or potential interest between managers and shareholders. This is called an agency conflict. So, an agency theory, we say that managers are empowered to make some decisions, and shareholders, they are the owner of the firm, they also make decisions. But when there is a conflict of interest arises between managers and shareholders, then this is called agency theory. Agency relationship means that there is a relationship between managers and shareholders, managers or debt holders. So managers, they have their own personal goals. Shareholders, they have their basic goal is shareholder wealth maximization. So when competition arises between managers and shareholders, then it creates a this agency relationship creates a conflict between the interest of shareholders and managers, which is called agency theory. So in agency relationship, shareholders are called principals and managers are called agent, because managers are the one who are provided with some responsibility and authority. Shareholders, they give authority to the managers. These are the individuals. Shareholders are principals. These are the individuals who make higher investment, who purchase the large percentage of the shares and make high amount of investment inside the organization, and they hire other individuals or organization to act for them to provide services to the shareholders. These are called agents, who are managers. So managers, they perform service and delegate, these shareholders delegate decision making authority to these agents. Agents are called managers. Now, shareholders and managers, there comes agency problem, because when managers, they perform activities and they try to perform business operations for their own personal interest, like increase of the salary or increase of the authority and providing job security, or having a good status. So for that purpose, then managers, they perform some business operations. When the conflict of interest arises with the shareholders, and so it means that there is a agency problem exists between managers and shareholders. But there are some mechanisms that is used to motivate managers. These are managerial compensation and the threat of takeover and direct intervention of shareholders and threat of firing. So in the threat of takeover, managerial compensations means that some compensation, some benefits are provided to the shareholders. Because the primary goal of manager is to increase the size of the firm and to grow a firm. And the manager's goal is to have a job security, so they try to avoid firm from hostile takeover. They want to they work for higher status, for higher power, and to gain good salaries. So they create, not only they create benefits for themselves, they create opportunities for the lower and middle level managers. So now there are some mechanisms that are provided to motivate managers, that is the managerial compensation, the threat of takeover, and direct intervention of the shareholders, and threat of firing. So the threat of takeover means that hostile takeover, when one company is not performing well, its management is underperforming and inefficient, then it becomes uh, then it is acquired by, it becomes a target for the other firm, it is acquired by other firm. This is called hostile takeover that managers try to avoid it. Then there is a direct intervention of the shareholders. When shareholders they take active steps and make active controlling behavior, they try to control the behavior of managers, and this is called direct intervention of the shareholders. And other component is the threat of firing. So on in that basis, these managers they try to work according to the interest of the shareholders, and to increase the shareholder wealth maximization. And some of the compensations are provided to the shareholder in the form of performance shares. Performance shares means that senior managers who are performing in the large corporations, they are provided with the performance shares, which means that the stock awarded to the executives on the basis of the company's performance. When companies actual performance or executive services are determined, on that basis shares are given, which is called performance shares. So this is considered as a compensation given to the senior manager on the basis of the company's actual performance and executive services. Managers perform action to maximize shareholder wealth, like analyzing financial assets. Those assets they invest in those assets that are able to generate future cash flows, that have high future cash flows. And they also assess the timing of the cash flows, because cash received sooner is better than to be received later. Investors they oversee the risk associated with the asset, because the shareholders they invest in those stocks whose cash flows are certain than with the risky cash flows. So in these are the components, and these are the some certain actions that are taken by the managers in order to increase the firm value, because when the firm values increases, then stock prices also increases, and in return cash flows increase. So it reduces the riskiness that is associated with the returns obtained by the firms. Firms are able to have or attain a higher returns in the form of the high cash flows, which is called today's or future cash flows, and which in turn increases the firm value. Then firm increase in the firm value will increase the stock price, which is the goal of managers and shareholders as well. So these are the actions performed by the managers to increase shareholder wealth. I'm repeating this point again. Managers they perform some action to maximize shareholder wealth. The first action is analyzing the financial asset. The second action is timing of the cash flow. And the third action is investors, as they are averse to the risk. So these investors they will try to invest in those stocks whose cash flows are certain than the one who have risky cash flows. So managers they will purchase those assets that are able to, or they will invest in those projects that will generate higher cash flows. And they will also try to invest in those assets whose cash are received sooner, because cash received sooner is better than to be received later. Then investors, as they are risk averse, so they try to invest. They will guide stockholders to invest in those stocks whose cash flows are certain, then who have a risky cash flows. So these are the actions performed by the managers to increase shareholder wealth. Then, in the end, financial managers they see that how much of the earning should be reinvest in the firm, and how much of the percentage of the earning should be paid out in the form of dividends. So dividend decision policies are made by the firms to determine that how much percentage of the dividends should be how much percentage of the earnings should be pay out as dividends to the shareholders. So with the help of all these decisions and managerial actions, they are able to maximize earning per share. So earning per share is and profit maximization are basic concern are basically associated with the stock price. Managers they increases the stock price. Managers work to increase stock price. They exert their full potential, their effort. They work hard to increase stock price with the help of the, which is determined with the help of the profit maximization. Profit maximization means that when the firm is able to maximize its to have a higher net income, because net income, if net income is high, then the profit maximization is attained. When profit maximization is attained, then the stock price will be high, so which is easily assessed with the earning per share. Earning per share is determined with the help of the net income to the number of shares outstanding. Earning per share, cash flows, stock price, they are all interrelated. Once earning per share increases, cash flows increases. When cash flows increases, stock prices increases, and when stock price increases, then the firm's sales increases. Then it in return it increases firm value.